Things that were exclusive, being able to find the data and work with it, are no longer exclusive. I think value investing has lost its way. There are three R words that I use to describe value investing, and none of them are complementary. The first is value investing has become incredibly rigid. It is full of things you're not supposed to do. You can't invest in stocks that don't make earnings. You can't invest in tech companies. It's also very ritualistic. There are things you're supposed to do as a value investor, and God help you if you deviate from the script. And finally, value investing has become very righteous.
We agree to disagree, Mr. Dean of Valuation. In fact, value investing is all about looking for unrecognized value wherever it can be found. And just like Ben Graham himself, the god of value investing, said, those who don't remember the past are condemned to repeat it. And it looks like the Dean of Valuation is falling in this trap. So welcome to Value Hunt, and here's a brief overview on what this value investing strategy is all about. Quick disclaimer, everything I say in this video is information I have studied/borrowed from people who know what they are doing. You shouldn't take my word on anything, be an independent thinker. I must start by explaining the key value investing concepts, such as intrinsic value. This is simple but not easy, is a somewhat subjective figure on how much a business is worth. It is difficult to estimate, just like Warren shows us here.
Charlie and I were each right now to write down on a piece of paper what we think the intrinsic value of Berkshire is. Our figures would not be the same.
So let's use Bob's analogy to figure out why a business may be selling for less than its intrinsic value.
The CEO of Bob's Construction is convicted of fraud. Even though stock for Bob's Construction has strong fundamentals and a history of steady growth, Rob's conviction generates negative publicity for the company, and the stock price drops 60%. The reason for the drop is that the scandal caused some investors who value corporate governance to lose confidence in the company. Although the scandal hurt both the reputation and stock price of Bob's Construction, a discounted cash flow analysis of the company determines that the intrinsic value of its stock is still $50.
Then we have the margin of safety. A margin of safety, as defined by Investopedia, it's an investing principle in which investors only buy businesses when their market price is significantly lower than their intrinsic value. Or as Warren puts it,
You don't drive a truck that weighs 9,900 pounds across a bridge that says limit 10,000 pounds, because you can't be that sure about it. If you see something like that, you go down a little further down the road and you find one that says limit 20,000 pounds, and that's the one you drive across.
And finally, let's take a look at the Benjamin Graham formula. This is a metric to determine the highest price that an investor should pay for a particular stock. Although you shouldn't rely entirely on one figure, much less on a formula, this distills the key pillars of value investing at its pure state. It takes into account pricing thanks to the figure 22.5, which represents PE ratio, no greater than 22.5. It also looks at the profitability of a company thanks to the EPS figure. And finally, the value of the equity of the business per share, book value, reflecting the total assets minus total liabilities that a company holds. If you are new to this, you might be asking, okay, but how does it perform against other strategies? And why can't I just invest in the next Amazon and 10x my money in a few months? Well, let's take a look at this question. First, let us be instructed by our guru.
But anybody that tells you you ought to have your money in growth stocks or value stocks really does not understand investing. Other than that, they're terrific people.
Thank you, Warren. But generally, growth investing, it's about investing in companies that are expected to grow at an above average rate. As we may sense after hearing this, sometimes growth is a big excuse for deploying capital at undesirable rates of return, and it may also be subject to the shiny object syndrome. Let's try to play devil's advocate and knock down both these schools of thought. Starting by value. Value opportunities may be few due to the high competition and higher efficiency of the markets. In case you don't run a very concentrated portfolio, you may lack some diversification and your needs might not be met using the value strategy. Another big downfall of value investing is the fact that it requires a whole lot of patience, since the time horizon you may be looking at is 5 to 10 years or even more. Now let's take a look at growth. So growth companies by definition grow at a higher return than other companies. This rate of growth it's very difficult to maintain over time and it's almost certain to drop. Another big downfall of growth investing is the fact that growth companies are extremely difficult to value, almost impossible to be honest. The third one is the fact that growth companies may run a lot of debt in their balance sheets, and this is a big catalyst for bankruptcy. You may incur the risk of your whole position going to zero, which is very, very bad. But because our goal here is to be objective, let us not forget that the investment strategy you use doesn't guarantee good rates of return. Ideally, you should pick whatever fits you the best from both strategies and maybe use a combination of them. Because at the end of the day, what you really want to have is a good rate of return, and it's how you apply a strategy that really makes a difference and moves the needle, not which strategy you are using. You may be the best growth investor of all time and be very bad at value investing, or the other way around. So beware of that. Now let's take a look at some financial metrics that might help us spot undervalued opportunities. Keep in mind that some companies might show awesome financial metrics and be terrible investments. So beware of that. The first one is the PE ratio. This ratio shows us how much the market is willing to pay for the earnings of a company. Keep in mind that the lower the ratio, the less of a premium you are paying for the earnings. Secondly, we have the price to book ratio. This ratio is so important for investors because it tells you how much the market is willing to pay for the book value of a given company. If we have a price to book value ratio of 1, this means that the market is paying only the book value for a given stock. This is very good for pinpointing possible investment opportunities. Then we have the current ratio. The current ratio measures the ability of a company to pay its short-term obligations. This means the short-term debt of a company. If the ratio is greater than 1, it means that the company is able to pay its debts easily with the cash that it has on its balance sheet. This is a simple metric to address debt. Keep in mind that it's not very good for comparisons, so use it individually for each company. To finish this introduction about value investing, let's take a look at the most common mistakes most investors do so you don't do them too. So not understanding the business model of a company is one of the main reasons why investors fail in their bets. Secondly, we have the problem of falling in love with a company. If you fall in love with a company, this may well skew your analysis and end up in a bad investment. And finally, being emotional about the price Mr. Market gives you, it's also a main reason to why people fail in investment. Remember,
In the market, you're going to have a partner named Mr. Market, and the beauty of him as your partner is that he's kind of a psychotic drunk, and he will do very weird things over time, and your job is to remember that he's there to serve you and not to advise you.
if you were focused today, you'll learn about value investing concepts, value versus growth, financial metrics, and some common mistakes most investors do when they start investing. Please keep in mind this is one of my first videos ever, so please give me a hand and comment down below any suggestions or feedback you may have. And as always, remember, day by day, in every way, we are getting better and better.